Good evening, everyone, and a warm welcome to today's webinar. I am Sheikh Shafiullah from PMS Bazaar. We are gathered here to discuss a topic that's increasingly capturing the attention of investors around the world. And the topic is how to invest in the era of trade wars. So global markets today are under significant strain. Inflation remains stubbornly high. Central banks continue to tighten monetary policies, and geopolitical tensions are mounting. These combined factors are pushing the world economy closer to what many fears would become a global recession. In this changing world, investors face an important question. How can they invest smartly when the rules of global trade are changing? To help us decode this complex new world, we are thrilled to join by Mr. Amit Doshi, co-founder and investment director at Care PMS. So Amit brings with him over a decade of hands-on experience in equity research and portfolio management. He has been a key architect of Care PMS's investment strategies as well. With assets under management now exceeding 1,000 crore, he is a chartered accountant by qualification. Amit combines analytical depth with real-world insights, making him exceptionally well equipped to navigate both calm and choppy markets as well. So, Amit, it's a truly pleasure to have you with us today. We are excited to hear your perspective on how investors can position themselves in the shifting global landscape. So, welcome, Amit. Let's get started. Before we start this session, I would like to request the participant to drop their questions on Q&A box and don't ask any questions in respect to a stock specific. So, what do you, Amit? You can take this session forward.
Yeah, thank you. Thank you, Shafi. Uh, just 1 second, I'll just share my screen so that if you can confirm if everybody can see the PPT. Thank you, PMS Bazaar, for organizing this. And good to see that, despite a very long weekend, there are so many participants who are attending this webinar. Definitely, this topic is of obviously a lot of attraction and attention since beginning of this financial year. So yeah, anyway, so without wasting much time, let's jump into it. So yes, as topic is, how do you invest in this era of trade wars? First things first, disclaimer, obviously any examples, any names of the companies that are discussed in this presentation are obviously only for the purpose of academic discussions. It does not construe any investment recommendation, and we will have or we might have some exposure to it through ourselves or our clientels. So just to take through the agenda, what we'll be running through in next 30 to 40 minutes is history. We'll discuss what are the current Trump tariff plans, how India is placed in this war, which sectors are either winners or losers, and how world is responding to this, and what as an investor you should do, because ultimately all said and done, what is it that one should be doing is something which is of more relevance rather than anything else. So that's going to be the broad contents that we'll be discussing. So first point, history, because it's always said that history is never repeated, but it rhymes. So it's always better to look through what past or what history has been in likely or such trade wars. So there are broadly four wars that has trade wars that has happened in past, starting with 1930, as old as 1930, and something which is as last as 2018, where Trump's first presidency was there. So that's broadly the list that we'll do. We'll discuss it one by one. So first is the 1930, the smooth and holly tariff. Basically, this is a tariff that was levied to protect U.S. farmers. This is primarily done after 1929 depression in order to protect the farmers' interest. But later on, these tariffs were extended to other industries as well, not only for farmers' products, but also to other industries to protect them. And the tariffs were in the range of 20%. So what the impact was, again, it started trade wars with countries like Canada, France, Spain. They were having a good trade balance with US in those times. And the impact was that global trade significantly declined during that period. In fact, to give you a number, so this was levied in 1930, and by 1933, the US exports were down by 61%. And in fact, the Great Depression further further degraded or further depressed. And in fact, there are some says that the World War II began after this trade war. So that was the trigger or the impact of it. In terms of how did it end, after 1934, a lot of countries signed a lot of bilateral trade agreements with the US. I mean, if I go by number, the 19 countries who signed up those agreements to kind of reverse the impact and to rebalance and realign the trades, so that normalization came through, and again the balance started. So, but that period was quite bad. So, if you will see in this chart, this is basically a value of the global trade that happened. And if you'll see between 1930 to 1940, the trade had almost remained flat. And post which after World War II, the global trade began rising again. So that's broadly, that 1930 impact. The next trade war began in 1960. This time, I mean, like while in 1930, it was started by the US, but in 1960, this tariff war, which was started by Europe, and it was known as Chicken War, and it is as on date also still known as Chicken Tax. So I'll just give you a brief. So in 1960, for some reasons, US had significantly promoted to promote poultry farming. They had done a lot of steps, and pursuant to which there was a lot of chickens that were produced very cheaply in the United States, and obviously they started exporting. And European Union, found it yeah, to kind of impacting to their European farmers, and therefore to protect their interest, they levied chicken tax. It was obviously per cents per pound. So that was the initiation or the beginning of that war. Again, what was the impact? Similar, there was significant trade decline between Europe and the US. It was dropped by 30% between that 1 year, 1962, 1963. And in fact, there was a retaliatory tariff which European Union did to the US, on potato starch, brandy, automotive trucks, etc., on multiple products. And later on, obviously, over a period of time, it reduced after some, I think 1960, after 1965, it reduced. But the automobile trucks, the tariff on the automobile truck still remains as on date as we speak, and that tariff of 25%, which there. So what ultimately happened was obviously that the trade decline, and then ultimately they signed agreement. So the balance part was removed, but the automobile truck still remained, and pursuant to which a lot of German companies, they couldn't enter the US market. And in fact, multiple companies from the Japan, they set up their own plant in the US to kind of cater to the market. And obviously, the companies like Tesla and all obviously was homegrown companies pursuant to this. So I think to some extent, what they probably would have wanted, they kind of achieved the goal of shifting some manufacturing base to the United States, more manufacturing capacity, and obviously some innovations like Tesla, etc., did grow pursuant to this trade war. So that is the second trade war, as I said, and one part of it still exists as on date, which was started as from chicken. Again, in 2002, this was again started by US, where to protect the domestic steel industry, they levied import duty of 8 to 30% for the steel industry. Again, impact was same, significant reduction in the global trade. The steel imports dropped as high as almost 37-40% in next 1 year. But unfortunately, what happened is the smaller US steel companies somehow didn't survive, and either they couldn't survive or they got acquired by very large steel companies. So overall, if you see, there was a very negative impact of this war. So global trade is clearly was down, but the local companies, also smaller companies, shut down and went bankrupt, etc. But then again, retaliation did happen from the European side, but it was just a threat that, on multiple goods, whether Harley Davidson bikes or whether some oranges, etc. A lot of that we will be putting a lot of tariffs. But because looking at the domestic part, George Bush, I think he was the president at that point in time. He To nullify the negative effects of that tariff, it made a lot of adjustments. Initially, cut a lot of items from the steel products, and then later on completely moved out from that tariff. So that is how it did end. But broadly, it was again significantly negative for the US steel industry and US economy in general as well. So that was the third war. And just to give you a perspective, so during that 2002, 2003, 1 year, the fall in the European stock market was as high as 40%. But as you can see from the chart, it later on recovered quite well over a period of time. And yeah, so that was the impact. Now, moving on to the most latest war, which is now can be regarded as Trump 1.0. So again, this was primarily on China, honestly, and to protect some industries like steel, aluminum. So these were the two categories that which Trump wanted to target. So it introduced tariffs on solar panel, washing machines from China, and some 25% tariff on more than 800 products of Chinese. So a lot of tariff primarily targeting China. Again, impact was retaliation came through from China. There was a huge tariff again put on some products from US which were being imported by China. And a lot of global products for steel and aluminum industry, which they also had put in, not only China. There was a lot of retaliation did came from Canada, Mexico, and EU, etc. Ultimately, this US-China trade war did continue for quite some time. And China lost its position as top trading partner. It was there with the US to Mexico in 2019. But however, again, after some time, how did it end? So in 2020, after the Trump administration was over, Biden joined in. He some tariffs were expired, and some still continued as a part of this tariff war, which had started in 2018 by Trump. So again, there was an impact. As I said, China lost its top trading partner with US. So impact of tariff is used. So and during that period, again, if you look at US markets, the fall for that one particular year when this Trump war had started, the market was down by around 13%, and but later on it did recover quite well. For if you look at China numbers, then again there was a fall of as high as 26, 27%, which it did recover, but it remained flat as you can see from the chart. But broadly, I would say that's because Chinese economy overall didn't do that great, and therefore post COVID, and therefore the chart looks broadly green. But yes, the impact of tariff did had an impact for a year, and then it recovered. So basically, just to conclude or summarize of last four history wars, so trade generally gets severely impacted. We saw 30% impact to 70% impact. So there's huge impact that happens whenever such tariffs are levied. Smaller business faces a lot of challenges. That's another learning. There is a huge likelihood of retaliatory tariff that happens, and the fear of which is very real, because you notice out of four, at two times they had to reverse because of the fear of retaliatory tariff. So that's a tool which is used to kind of close or come to some sort of a conclusion. New manufacturing obviously does take place, but it takes a very long time or a good gestation. It needed to other countries, company coming to that country and then setting up their own manufacturing base, etc. So while that do happen in short time, but in some cases, but it takes quite a long time. For a period, definitely stock market returns are impacted, and they can be negative for some time as well. But ultimately, the solution is bilateral trade agreement, is what we saw in all cases where they do enter into some sort of agreement whereby they agree on some terms as to how they will want to balance the trade and trade deficits. So that's broadly the history, including Trump 1.0 tariff war that we discussed. Now let's move on to Trump 2.0. But before we move on, I'll just want to, there's a poll that we have scheduled. Shafi, if you can post the poll. The reason is obviously, we had scheduled this poll, but, obviously, as everybody might have known, that Trump has put a pause on 90-day, put a pause for 90 days. So just wanted to know your views as to what could be the key reason why you think that, Trump put a pause in tariff for 90 days. You can select, top two according to you, and just we'll wait for a minute before the poll gets closed or for the voting. Okay. So the results are out, and majority of you believe US bond market has been the reason. Yeah, very true. I think this is one of the key reasons, because the expectation was that somewhere US bond yields would come down, and that would allow Trump probably to kind of bring down its borrowing cost. But yes, in fact, the reverse started happening. But nobody knows the true reason. Obviously, we'll never be able to know what kind of thinking process Trump has in his mind. But yes, I think most of you have a very good idea about that. Bond market was one of the key reason, I would like to believe that it had to put a pause on the recent tariff that is there. So, anyways, we'll move on. Thanks for sharing your ideas. Now we'll just move on with the uh, yes. So first, of course, why tariff 2.0 did begin? Obviously, the biggest reason was trade deficit. This is a very, high deficit on which US was running. And Trump wanted to bring in a lot of manufacturing to the United States, and obviously a lot of investments. And he still believes that he has a lot of commitments in terms of a lot of investments coming to the United States. So that's one of the key reasons why he wanted this tariff war to begin. He did sign. Obviously, now it's reversed. Almost on 60 countries, he wanted to leave levy tariff. The base tariff, 10% on all goods which are imported to the United States. So that remains. Of course, earlier there was a different methodology which was used. We'll just discuss shortly, briefly, because it still remains relevant, because it's, as of now, it's a pause button that they have put on the tariff. So that's the key part. Now, if we look at what is the list of trade deficit that the United States have pursuant to it's all vis-a-vis its all trading partners. I've just taken top 10 partners, and if you look at, obviously China is on the top with EU and Vietnam holding second and third position. So they three put together hold more than 55% of the trade deficit that the United States have. So that's one of the reason why obviously he wanted to do that. And of course it levied different rates to different countries depending on the trade deficit. And if you look at the India, which is in the top 10, ninth partner, ninth rank, but we were earlier proposed at 26% of tariff. We contribute just less than 4% to the United States USA trade deficit. But yeah, that's the number for ourselves. Now, of course, it's been postponed for 90 days, but this calculation might be relevant because we never know how things pan out in these 90 days. So the original idea was reciprocal tariff, and if you have heard Trump in a lot of press meets and news, he's always said, what you charge us, we will charge it back to you. But is it really a reciprocal tariff in true sense? So my answer is no, because what he has technically done is trade deficit. He has just calculated trade deficit which each of the country divided by the total imports that US has with that particular country, and that's the percentage. So that's nothing but the trade deficit, and that percentage is discounted by 50%. So it's not that while we might be charging say 10% on particular goods importing from US, then he has to charge ideally the 10% vis-a-vis that product somebody is exporting to US. But what he has done is just pick up this trade deficit number, and based on which he has levied a tariff. So nothing but pursuant to levy of tariff, the trade deficit gap is filled up, and that's the broad formula that he has worked on. I don't think it is can be mentioned or can be called as a reciprocal tariff, but that's what he has been talking all this while. But this is the formula just for the purpose of reference. Moving on, what could be the likely impact? Obviously, we have seen earlier in past. The first point is reduction of global trade. So trades can significantly reduce. As for multiple reports are there, but there is one estimate by which the US tariff it's anticipated the global trade can be down by 1.6%. Global GDP can be reduced by 1.6% pursuant to this levy of this tariff, which he had proposed. Obviously, now things have changed. Second, inflation, because primarily US is the one which is going to import all the inflation, because tariff is just going to increase the product price and nothing but US consumer is going to pay higher. Obviously, how the tariff would be consumed in the entire supply chain, we do not know whether manufacturer will absorb some, the distributor, the stockist, and the retail and the end consumer. So overall, the net impact could be lower. But broadly, whatever he was paying till say 8th of April, it is going to go up from say whatever 10th or 11th or 12th of April. So that's something. What percentage which will be passed on to the end consumer, we would never know. But that's higher inflation is for sure to be there. Commodity and currency, the impact on commodity and currency, because clearly the global trade reducing is one of the global slowdown reason, and then the currency fluctuation, commodity prices like metals, crude oil, we already saw them falling, and that's the clear impact on that. And fourth, retaliatory tariff by multiple countries. So we saw Canada announced, EU announced, and China, the war is still continuing. So that is something which is the retaliatory tariff. Now, in all this global trade war, let's see how India is placed. So there are two obviously impact. One is direct impact and one is indirect impact. So the direct impact, what we have just calculated for the ease of everyone, is that if you count our exports, which is around 87 billion, and currently pharma and petroleum products are exempted. So around $74 billion is what we export till say 2024 we have done. And if we count reciprocal tariff of 26%, and we presume that the demand would get reduced anywhere between 10 to 30%. Demand would be reduced by 10 to 30% because the goods will become expensive for the United States, and the demand will be reduced pursuant to increasing prices. So the net impact is around 7 to 10 billion is what we have computed based on that number of reciprocal tariff. And so that divided by our economy of or our GDP, 4 trillion is nothing but 0.2 or 0.3% of GDP. So the direct impact clearly is very negligible vis-a-vis the US tariff war. But the indirect impact, which could be the larger one, is global slowdown. And if that happens, obviously the demand slows down. And not only this $87 billion, there are a lot of other things also can significantly get impacted. And the second part is the currency, fluctuation. So rupee depreciation or volatility in rupee can significantly impact us because we import a lot of stuff, etc. Basically, why we all know that US is the largest contributor to our exports. Can anybody, can just take a call who could be the second highest contributor in our exports? India exporting to other countries after United States. Who is the second highest contributor? Okay, great. The results are out. Yeah, okay. So the first preference goes to UAE and second preference goes to China. I think I must say we have a very knowledgeable and smart audience. So yes, you are right. UAE is the second largest contributor to our exports. We'll just move on to the answers. Yeah, so here's the list of India's overall exports and what United States and other countries hold. So if you'll see, US obviously hold the first trading partner, which is contributing 18% of our exports, followed by United Arab Emirates, UAE, Middle East, which holds around 8%. So the idea is obviously US is very idea of having this table is US obviously is a very big contributor for us as far as exports are concerned. But broadly, our exports are widely kind of diversified. If you'll see, top 10 countries also contribute 50%. So there is and all are in the range of two single digit contribution. So we have a very wide kind of diversified global portfolio as far as our exports are concerned. Now coming to the USA particular, out of that 18% that we have, what are the sectors that are contributing to it? And as you can see, we just taken the sectors, electronic goods, gems and jewelry, pharma. They are the top three. And if I were to just add textile, in the sense ready-made garment and textile put together, they also hold around 12%. If you can see, after agriculture, there are ready-made garments and textile. So we put together contributes around 12%. So these three, four sectors are significantly contributed to exports to the United States. And on the right hand side, you will see what is the current import duty by US that is levied to us. So that's obviously highest in the textile segment, which is in the range of 10%. So that's broadly our sectoral exports to the United States. Now, what is the India advantage in all this? There's a significant global opportunity that we have, because in the whole scheme of things, we believe that there is a lot of global realignment that will happen. Now, the differentiation between the past trade wars and this trade war is the US had a particular country or a particular product targeted while levying tariffs. Now, in this situation, because Trump wanted to address entire trade deficit of the United States, what it has done is it has done for anything and everything, any product coming from any country. It was neither a product specific or a sector specific, or neither a country specific tariff. So it applies to all, just that the rates that applied are different. So what is likelihood that there is a significant global realignment that might happen, and where India can significantly, play its role to grab opportunity of other countries as well. So that we believe is a very good advantage that India has. Second, domestic economy. Our Indian domestic economy itself is very strong. And while US accounts for 18% of our exports, but in our GDP, the goods export is just 12%. And obviously, as an export, including services, is 21%, but goods export is just 12%. So while I mean this will have an impact, but we are significantly, our GDP is significantly determined or kind of governed by our domestic consumption. So that will play in our favor, and that is something which India will have an advantage over others. Economy like China, where they are significantly export oriented countries. So we are not in such situation. Now, export competitiveness. Now, for example, while Vietnam, Thailand earlier had proposed higher tariff, but now currently it's on a pause till the time this 90 days is over. But China still has a very high tariff. Now, wherever we and China both are present, there is a significant opportunity for us, because we'll become more beneficial vis-a-vis those countries to the United States, and we'll have the opportunity to cater to that additional demand. So that competitiveness will come to us if this holds true. So that's the third part. And China plus one, which I think I almost spoke. So China plus one earlier was also, post COVID, China plus one was a theme that had played. Now that theme can again restart, and if government is really serious about it, we can really capture good number or good market share of this China plus one opportunity. So this broadly the idea advantage of this global tariff war that is going on. Now, this particular five sectors it's listed, and earlier obviously we had done this comparison because China, Vietnam, Indonesia, Thailand, these had higher tariff than us. So we wanted to kind of see which sectors they are exporting to the US and what is our share. So there is a inherent advantage by virtue of high tariff by US to those countries and lower tariff to us. So we have an additional edge to cater. And if you see computer electronics, textile ready-made garments, now we contribute considerable, but now we have a huge advantage to kind of capture the share. And same way, footwear, leather products, toys and equipments, there is a strong opportunity for us. So these five sectors can be focused upon depending on how now things shape up. So, I think, yeah, this point I somewhere indirectly covered, like textile and garment. We hold around 9% of US imports, and China and Vietnam holds 14%. So there is a significant opportunity for us, because China obviously has a very high tariff as of now. I think as high as 154, 184. I don't know. The number keeps rising each time I open the news. So we really don't know what, but anyways, it is far higher than what we have. So let's see how things pan out. But we have a good opportunity there. That can be something, and like other sectors, electronics, footwear, toys, etc. That is something which can be captured on. Now let's move on to our sectors broadly, impact on our sectors. So these are few sectors that directly get negatively impact of four sectors and few neutral to positive. So we'll quickly move to the first sector, which is IT. So while IT is not directly covered under this tariff, but clearly because of inflation in the US and the slowdown or the kind of the orders that has been the contracts that were likely to be awarded to these US IT Indian IT companies is something that can have an impact. And for us, our IT revenue, the 60% share is from United States. So that's something which is very big for us, and therefore it could be have a big negative impact for this. And broadly, the companies that are export oriented listed companies are Emphasis, Persistent, Mindtree, HCL, and Infosys and TCS. These companies have a significant exposure to the company. The next is gems and jewelry. Obviously, they had hardly some 2 or 3% of import duty so far, but now with this 10%, not the 26%, the 10% tariff will make impact. We have around 13% share in our total exports of gems and jewelry, and for the US, we have, we are 30% contributing to their imports. So it's again a sizable for both the countries. And one more part was that this sector was anyway struggling for last 1 to 2 years because of lab grown diamonds, because overall slowdown in demand, increase in gold prices. So they were anyways struggling. So this has potential to job losses because this is sizable employment given to gems and jewelry. So a lot of government action would be needed in this, and let's see how things pan out. But yeah, some export players like Goldium, Renaissance Global, Vaibhav Global, these are some key players, and they had impacted also now with this change of tariff. Of course, they were up also today. So that's gems and jewelry. Chemical, it's not a very big number for us, but I think if I have to see all this, there are four baskets, obviously: specialty chemical, organic, inorganic, agrochemical. But agrochemical has the highest share, so we have almost 14%. We are highest exporter in US. 14% of US imports is contributed by India, with Mexico and China at second and third position. So agrochemical is something which is a very significant contribution. So that is something which sector could get impacted, and that's something which we'll need to keep in mind. The various stocks which are listed space are Navin Flora and PI Industries, UPL, SRF, etc. So these are some names that can be kept in mind while keeping the trade war in thing. Auto, again, not something that has come up now. It was already there in March. They had announced 25%. So that already had. We do not have direct significant exposure again auto, but we have some companies, primarily auto ancillary segment, which could get impacted. So companies like say Tata Motor having this JLR exposure, Eicher Motors, and auto component Sona BMW, Bharat Forge, Samvardhan Motherson. So these are few companies that can have an impact depending on how overall things shape up. Now moving to the neutral to positive sectors. So pharma, so far it is exempt. It is currently not neither in the 10% basket. It is there as of now. As of now, it's not there. Plus, for them also we are very important because their US imports we have around 40% contribution, and therefore we believe that something like that can have a if they apply tariff, and this is something which is of a not a discretionary spend, so that can have a significant impact. And that's the reason why the ES kept on exemption, but we never know what can happen. So we'll have to keep a watch. And there are a lot of Indian pharmaceutical companies like Lupin, Cipla, Sun Pharma, Gland Pharma, Zydus, which has exposure to US in the range of whatever 25 to 45% of their sales comes from the US. So that's something which we will have to keep in mind while keeping this trade war in mind. Textile, I think I already spoke about it. We have sizable contribution, and there is a sizable scope because of higher tariff for the other countries. And we have a very good opportunity because we are a very good cotton producer, as well as there is a huge industry providing employment. And for a country like India, textile can really be a boon to grow our GDP and increase employment. And some companies like Wellspun Living, Trident, Irwin, all could be impacted, positively, hopefully. So keeping that in mind. And electronic goods is something which has significantly risen in last few years. One of the significant contributor is Apple's plant in India, and we had hardly 1,500 crore of exposure in 10 years back, 14, 15, and now we have 1.2 lakh crore of exports of electronic goods. So that's something which is a very strong opportunity that we'll have. And the key listed players are Dixon, Amber, PG Electroplast, etc., which can be kept in mind, and they can actually have a strong opportunity. And government do provide PLI schemes, etc., in this space. Now, how world is responding? Just a quick nap. Basically, obviously, Fed is equally concerned about tariff, and he's openly said that the effects of inflation could be more persistent. So that's the reason they didn't go for rate cut as well, while inflation, etc., were still in control. But he had the fear, and therefore he didn't do. IMF obviously has suggested to sit on the table, enter into trade agreements, because it will have a significant global slowdown impact. Coming to Indian Central Bank, RBI, just 2 days back, it is equally concerned about GDP growth, but marginally, because I said the impact could be very low, and therefore they have also reduced the GDP projection by 20 basis points. But the bigger concern for RBI could be the rupee depreciation. So that's something which we need to watch out for. EU has already retaliated, but now they have also put a pause, but they also don't like the strategy of tariff. Canada, again, not a trade deficit partner, but they have also retaliated, and they are also prepared for it. China, the biggest, and still the war is going on. So there are a lot of commentaries from China that they will fight till the end, etc. But I think since last night, this morning, the commentary from both sides have been slightly softened. Hopefully, this should get somewhere to the closer to the discussion table. And now coming to the most important part, which is, what should you do? So I think the opportunist sectors, like we spoke about, textile, ready-made garments, electronics, pharmaceutical, those sectors can be something that one should look for. Don't directly jump, but that are definitely a significant opportunities. Of watch out for government actions on PLI incentive scheme, or how other countries are entering into that space is something one should look out for. Focus on more domestic focused business, because see, this is not something that has ended now. It is going to go for quite some time of how these overall bilateral trade agreements get signed up. So focus on more domestic focused companies. And if you see, the primary sectors which can have the least impact is like, say, banks, financial companies, infrastructure sector, cement companies, agriculture, which is again significantly domestic driven, pharma, healthcare, food and non-discretionary spend. So these sectors, if you're part of your portfolio, that can give a lot of comfort during this volatile period. And at the end, I would like to say that stock specific approach will be very critical, because that's something which will allow, in the current times of volatile, the stock specific approach follows better, rather than just going sectoral, taking a call on sector. Just go on stock specific, because currently the stories will work more on stock specific approach. And first, analyze your portfolio. What are the companies, that percentage of direct exposure to US? What is the indirect exposure? In some cases, like commodity prices, metal prices, crude prices, lower of them could be better for a particular portfolio company. So that's something which we will have to analyze. And reshuffle your portfolio, because I think what I've seen in last bull run, which somewhere hopefully ended in, not ended, I would say, but kind of took a break in September, October 2024. Lot of in bull run, lot of portfolio gets gathered around narrative based companies. So just this is a good time for you to kind of evaluate your portfolio and reshuffle, because a lot of corrections have happened. So some good companies are also available at better prices. And remain watchful for the government action, because I think government is going to play a significant role, and that is where ultimately how the bilateral trade agreements are signed, how the incentives are offered to particular sector in order to boost manufacturing in India, how they enter into trade discussion with not only with the US, with the other countries. So there's a lot of things would be driven by government, and those government actions can significantly impact our sector. So that's something you should remain watchful of. In terms of portfolio, like Care PMS portfolio, if I were to see, now we have two strategies, growth plus value and large mid cap, and both of them have roughly 30% companies which have some exposure to the US. It could be 20%, it could be 50%. But broadly, it is pharma and staple food, and therefore we believe it will likely to have the least impact. So this is something similar analysis that one should do for your portfolio as well. And our market cap sectoral breakup is also shown on the screen. How we have structured our portfolio, and in the both the strategy, in the growth plus value as well as large and mid cap. And the reason of saying this is portfolio management is very critical, is because of this structure. How do you structure your portfolio is very important. And if you will see whether you can see 1 month, the March jump it had come. How do you outperform the broader markets or the benchmark indices? Or you see, say, let's take 3 months, because February had a significant fall, also March had a good correction. So let's take a slightly 3 month period. That also, your fall is slightly better. So we had around 8% negative compared to, say, 15% negative of BSE small cap index as far as the growth plus value is concerned. You want to go a bit far, 1 year, you see 13% vis-a-vis 8%. And if you want to go since last 12, 14 years, then 21% vis-a-vis 13%. So how do you structure your portfolio is very critical, and that's what I think I've covered in my part. So think with that, I think some credits to how this presentation has been made, used, the sources have been mentioned in the presentations. And thanks, and we can move on to Q&A.
Thank you, Amit, for your valuable presentation on markets and your PMS as well. And thanks participants for participating in the poll as well. And the forum is open for Q&A. You can drop your questions in the Q&A box, which will get answers from Mr. Amit right away. So forum is open for Q&A now. The question is, what are the current trade barriers imposed by India and how they led to one of our key trading partners responding with 26% reciprocal tariff? So I think you have already added this in your discussion. If you can add much more points, it will be helpful, Amit.
I didn't get, so what trade barrier we have placed on the United States is what is being asked?
So trade barriers imposed by India on the US
Because
import.
we are still under discussions. There has been no trade barriers that has been placed so far. So nothing as of now. It's discussions are going on. We are in discussion for trade agreement, bilateral trade agreement with the United States. So nothing as of now that is that we have started. So the Indian government so far has been silent on their actions.
Okay, got it. So there is one more question which you have mentioned in the market filled with volatility and changing narratives. Which investment approach tends to hold up better, like growth, value, or blend of both? Also, here you have your growth plus value portfolio, where positioned to capitalize the current market conditions. So, how you are going to look into this?
So I think, as I said in my presentation, also stock specific approach and see growth plus value both works together because if you go only into value, I don't think it works. And if you go only in growth, I don't think it works because I mean, it works during the bull phase, but it doesn't work during volatile times for sure. So I think growth plus value is what one has to kind of consider in mind. So there has to be value in the stock, but there has to be triggers for growth, like how or some sort of a tailwind for that sector, or some sort of a capex announcements, or some sort of growth triggers in the particular company. Triggers should be there in order to start the investment.
Fine. I have one more question where most of the investors do look into that. Even in these kind of economic shifts, what steps should investors take to safeguard their portfolios and to navigate the uncertainty? So where on the downside risk also they are specific about.
Yeah, so I think that's what I said that in my part also I covered it in the presentation that you first evaluate what part of the portfolio has export exposure, and in terms of export, how much of it is to the United States. So that's direct exposure part. The second one has to evaluate is the indirect exposure, which I also covered in my presentation. So this first evaluate that. If you believe you do not have the capability to evaluate, you please come down to people like, I mean, you can share your portfolio with us. We will review the portfolio and kind of, give you our remarks. But this is a very good time to reshuffle your portfolio because of this volatility. You will get mispriced opportunities in the sector, and focusing on domestic businesses. And companies which are like least impacted should have a bigger portion in your portfolio. And yeah, I think these two, three things, if you keep in mind and stay away from the companies which are likely to have a significant impact because of the trade war. So these two or three steps can significantly do a good sort of a risk management that a portfolio investor can do.
Yeah. Yeah, I mean, this is a very good value addition here, as you said, to review the existing portfolio that you can help it out for the participants as well.
Yeah,
So they
sure.
can look into that. Yeah. So here there is a one more question which is in sector specific when you're talking about your portfolios. So currently, which are the like which if you want to choose the top three sectors, which one will you be go for?
Top three sectors. Okay. So I think pharma could be one, cement infrastructure story could be second, and agriculture would be third. I mean, not in a particular order, but these top three sectors we believe would be kind of have a good lease exposure. And because of this US turmoil, some of these opportunities are mispriced or kind of underpriced at the moment. So that can one can have a good return after investing in these sectors.
So there is a continuation for the same question again, where someone is asking about the sectors to avoid or to reduce the exposures in these kind of markets, especially on the global shift whichever are happening with these tariffs and all.
Right. So again, I think in the my slide on the negative sectors or neutral to positive sector segment, I covered it, which are like, sectors that are likely to get impacted. So gems and jewelries, the auto, the IT, those have a significant impact. So it is tough to say it is a negative, but yeah, to jump on to those sectors will equally be risky at the moment unless the value is extremely high. But one would still want to avoid at this point in time because remain watchful of how things develop, like this global slowdown, like IT sector. I can see in Q&A one of the person is asking how is IT sector is in what basket or tariff, 10% tariff it is there. It's not there because it is a services. What they have currently applied tariff is only on the goods. So this is from part of services, but there is a significant indirect impact because of the US slowdown that is likely to happen because of this action of tariff. So I think to avoid these sectors at this point in time would be good.
Thank you for that. So there is a question in respect to one of your PMS, like growth plus value strategy, which focus significantly on the domestic sectors like textiles, cement, paper, which seems relatively insulated from global tensions. But
Right.
could these sectors still be impacted by tariffs or global slowdown? How resilient do you expect them to be in the current situations?
Right. So, yeah, I think good question. So, I think cement is something which will not get impacted because neither the cement can be exported nor it can be imported. So, that remains to be completely insulated. So, as far as domestic industries, domestic GDP is growing well. I mean, which is likely to do. I mean, as I said, RBI just mentioned 2 days back about 6.5% growth. So, if cement is likely to do good, I don't see any impact vis-a-vis tariff in particular. Now coming to other two sectors like paper and textile you mentioned. So paper, while again it is there can be significant imports in that segment. So there can be if there is a global slowdown, the prices can get impacted, and there could be dumping also. So it could get impacted. So that is one. And textile again, yes, but as I said, it offers a lot of opportunity also. Like I covered it in my presentation, neutral to positive companies. So we have a very good exposure in the US, and if China, because now labor is also becoming expensive in China, and the higher tariff in China. So if that is likely to stay for them, and say for example Vietnam, they come to some conclusion and they don't levy 46%, but they come to say even 30%, 35% higher than so far as India, then we have a opportunity to kind of, we will have a better level playing field vis-a-vis those countries, and we will have good opportunity to export. So textile will have positive. Cement, I don't see any impact. Paper could be negative, or so depending on how things shape up. Yeah, I hope this answers your question.
Yeah, Amit, thank you for that. So, along with equity, there is a one more asset class where most of the people are having the exposures, that is like gold. So, what's your view on the gold, and should we remain invest in the gold or book some profit, because gold are trading at peak today comparatively with the equities?
I am no expert on gold or commodities. We focus only on equity. So I don't think I will have. In fact, I've never invested also in gold. So I don't think I am the right person to answer on this question.
Fine, Amit. So,
I
no.
think as an investor, I would say just maintain your asset allocation rather than jumping guns on gold, because obviously currently it's at peak because of highly uncertain times. Now, once this streamline happens after say 90 days or whatever 3 or 6 months, then things could shape down, because gold has given significant returns in last 2 to 3 years, which is unlikely in the history that has happened. So somewhere that mean reversion could happen. But as I said, again, no expert, so better to ask somebody who is more skilled at this point.
Sure, Amit. Thank you for that. There is a question. I hope this is somehow specific to the stock. If that is okay, I can take that question for you, right? So there's a question which says that Zydos and Cipla are key holdings in your portfolio with notable exposures to the US market, while pharma-specific tariffs haven't been implemented yet. So what's your view on these companies' position in the face of evolving US trade policies? What is going to impact, and how you're going to take the call on your portfolios as well?
So yeah, I think I partially covered as a sector. Pharma, we think that I think it will be very tough for US to implement that. Like people had an anticipation that this is not going to happen. This is just for the negotiation purpose, and that's what ultimately has happened as of now. So somewhere pharma, which is one of the key, India is a very key contributor to the US pharma. As I said, I think almost 40% of their imports is governed by, I mean, is catered by India. So it will be very risky for them to kind of levy any sort of tariff, and pharma is something which is on a not a discretionary spend. So that can significantly impact, and that could be a very a negative bash from the American population to the Trump. So I think he would like to avoid that. So personally, senses it will not. And if at all that comes up, like whether it is 10%, 15%, 20%, we don't know. But let's presume the baseline tariff of 10% if gets implemented, I think majority of will be passed on. Maybe if not in first quarter, but in couple of quarters, it will be passed on. So I don't see a significant impact. And it's not that we are selling at a very high margin or a very high ROE business for us. So I don't think anybody else can set up a plant overnight there which can cater to their demand. So that would be there. So yeah, so whether it is Zydus or Cipla, I think answer broadly remains the same. Zydus has more exposure to their I mean US sales are higher, more than 40% exposure is there. So to that extent it has higher risk, but that's somewhere reflected in the current market price also. But yeah, I would want to add disclaimer that yeah, as you said, it is our portfolio company. So please, we have our interest in the stock. So take this advice with a pinch of salt.
So I think we are closer to end this session. So I will take a final question. So there is a question which specifically talk about the recession fears after these tariffs and all. So I hope the agencies like JP Morgan, Morgan Stanley, they come up with some kind of recession fears like 30%, 60%, where the possibility is higher. So what's your take on that, and how, because now there is a 90 days pause from the tariff by Trump as well. So how this and that are going to be linked and how the markets are going to be thereafter after 90 days I'm talking about. Somehow now it is like uncertainty is going to have some pass. So what after 90 days?
Think the original, like whatever, these reports come out of recession, etc. They are based on assumptions. Obviously, now nobody knows how these assumptions pan out. So obviously, we'll have to wait for those 90 days to happen. But broadly, if these tariffs are kind of implemented, like it is currently at the 10%, there is surely going to be inflation, surely going to be reduction in global trade. And at least for a short term, this is going to have a bit of issue. Now, recession is something which is a very tough to say, but yes, if you go by history, it has happened in past, so there is a likelihood of that. Now, what percentage is very difficult to comment, and I don't think we should even get into that. But yeah, that uncertainty definitely remains. So even after pausing of these 90 days, I don't think that uncertainty goes away. But broadly, it is significantly reduced. And now I think after 90 days, things broadly should be streamlined. And as far as you being an Indian investor, as I said, the impact on GDP is likely to be lower. And what is my sense is that how things will pan out would be the response by the other countries. So, like how EU, Japan, China, India, Russia, how they are responding to this. If they are able to manage among themselves, then probably it might happen that US may be the only loser in this entire game. So it is again very tough to kind of take it, but yeah, that's what my broad view would be.
So with this, we'll conclude this session and thank you so much for your valuable time, Mr. Amit, for sharing your valuable insights on markets, especially on the macro environment as well. There are a lot of questions lined up in Q&A box, which I would like to request Mr. Amit to give the answers to us. And the participants, you can share your queries at events@pmsbazaar.com, where we'll get answers from Mr. Amit and their team as well. Thank you once again for all the participants to the part of this session. Thank you once again, Amit, for giving your valuable insights.
Thank you, Shafi. Thank you, PMS Bazaar.